Now today we have gold relatively flat, down just a sliver. Again, it is struggling to get through this level. I would say it's building up energy for it to pop and have a breakout. We've seen this before where it trades sideways and it keeps hitting resistance and then suddenly it pops and then it runs. I kind of feel like it's getting close to this phase. It may still want to pull back and fall out of favor where everybody chases miners. They chase silver and platinum and palladium, which have all kind of broken out above the highs that we saw a couple of months ago. If we take a look at the equities market, we've been going through quite the roller coaster ride. When we look at the daily chart of the NASDAQ futures, pretty good sell-off, really running the stops. It ended up having a deeper pullback. And now the big question is, has the market flushed out in the past couple of days? Yesterday we had a strong rebound, trying to figure out if it's going to find traction and start to rally here. When we zoom out though and take a look at the 10-minute chart, we can see where we are in the overall range. It was a nice rally yesterday, but in the big picture here, we're really channeling to the downside. Now the big question is this high volume, big sell-off and big rally. Are we going to find some traction and start to head higher? Now this has been a series of sell-off, bear flag, sell-off, bear flag, sell-off. It looks and feels like it wants to rally and have a pause and then rally, so it could put in a bottom through here. So we'll see if today we get some type of bottom and see if the market can close fairly strong and then start to head higher, or if it is going to rotate back down in sell-off. So we are stuck at short-term resistance within the short-term kind of pullback in the market. Definitely this high volume is creating a lot of selling. Even yesterday, look at the volume spikes. Even though the market moved higher, it was still some heavy distribution selling. So there's still some big players selling into this, but we could hopefully see buying step back in this market recover. Now there's quite a bit of fear creeping up. Now we don't see it in the VIX because it's more so a technology sell-off. It's not a broad market sell-off. When the whole market sells off, that's panic selling. But when it's just very sector specific, like technology, the Magnificent Seven, it's not mass market selling. It's just very selective selling. And one big sector really moves the whole market lower.
Despite the turbulence, traditional fear indicators remain muted. This is not a market-wide liquidation, but a concentrated pullback led by mega-cap technology stocks that disproportionately influence major indices. Because selling pressure is narrowly focused, volatility measures fail to reflect the anxiety building beneath the surface. Volume data shows ongoing distribution, even on up days, indicating that larger players are still reducing exposure. Historically, this type of selective selling often precedes broader market decisions. The absence of visible panic does not guarantee safety. It simply means stress is building quietly rather than explosively.
Now, one of you wanted me to take a quick look at the VIXI, so let's take a look at the VIXI ETF. Now, they're saying this trade here has been a bit of a pain in the butt for them. They're expecting the fear to spike and the VIX to spike, and instead this ETF just keeps going down even though the stock market is falling. This is the reason why the VIX is so dangerous. You're trying to catch a falling knife, and the VIX is generally a falling knife always. Very rarely will you catch a 1 or 2 day pop and actually profit from it. If you look at the price action, it just keeps going down, and you really do need to nail a market sell-off for a very short-lived pop. And so this is, we stopped trading the VIXI many years ago because of this. If anything, you should just always be short this ETF and ride out the short-term lived spikes. That's kind of the way I think if you were to play it, if I was to play it, I'd be focusing on only short selling it when the VIX has popped. And we've seen this ETF move up. Now today, let's take a look where the money is flowing. Pretty much is flowing into all equities. We're seeing all the indices move higher other than the Dow, which is slightly down, kind of a little bit of, I think, energy play weighing down on the space. If we take a look over at bonds, we do have bonds slightly lower, so money into stocks, money into bonds. Bonds continue to have this little bit of a bearish pattern. It put in a little head and shoulders. It's broken down through the neckline. It now has a bear flag that points to potentially another little leg down.
Tracking money movement across asset classes reveals a mixed picture. Stocks have attracted short-term inflows during rebounds, while bonds continue to weaken, suggesting investors are not fully embracing safety. The US dollar, meanwhile, has found support after a measured decline, rebounding from key technical levels that often act as inflection points. These currency moves matter because a stronger dollar typically pressures risk assets and commodities. Together, these signals imply hesitation rather than conviction. Capital is rotating tactically, not committing long-term, as markets search for their next dominant trend.
Now we are seeing the dollar move higher. The dollar's up 1/4%. It has had a multi-wave pullback, pretty much a measured move to the downside. If we take this high, this little bear flag, and its high, and carry that forward, we talked about how this measured move hit this level, and since then we have bounced. And now we need to see if it's going to get traction and want to start to move higher, or if it is going to roll over and continue to go deeper. But it has pulled back to a very significant support level and a kind of invisible Fibonacci support level. And that's what I love about Fibonacci targets using the 618 and 100% is most people don't use it. Most people don't know how to use it. And they're invisible support and resistance levels. They tell us where momentum in the universe is going to stall out in an invisible level. It just floats in space. And that's why I love it. That's because if people can't track it, they don't know what they're doing. And there aren't any price levels around there. This is a way to kind of know where things are going to turn around or run into some resistance. Now today we have gold relatively flat, down just a sliver. Again, it is struggling to get through this level. I would say it's building up energy for it to pop and have a breakout. We've seen this before where it trades sideways and it keeps hitting resistance and then suddenly it pops and then it runs. I kind of feel like it's getting close to this phase. It may still want to pull back and fall out of favor where everybody chases miners. They chase silver and platinum and palladium, which have all kind of broken out above the highs that we saw a couple of months ago. But I still think gold will follow suit and move higher with obviously a lot less volatility. But I do think it's a higher probability that gold could become the leader, and we might see the actual other precious metals maybe pause and pull back while gold takes leadership for a short-term play. So I'm starting to like this for maybe getting into another quick little gold trade for a breakout and a move up going forward. I'll keep you posted if I do that.
Gold remains subdued on the surface, but its behavior is constructive. Prolonged consolidation near resistance often precedes powerful breakouts, especially when momentum quietly builds underneath. While other precious metals have surged ahead, gold's lower volatility makes it a frequent late-stage leader. Historically, gold tends to assume leadership after speculative enthusiasm cools elsewhere. Current price action suggests energy is being stored rather than released. Should macro uncertainty increase or equity weakness persist, gold may emerge as the primary beneficiary, resuming its role as a stabilizing force during periods of financial stress.
If we take a look over at silver, it's up 1.1%. Silver's having has had a very nice run, stair-stepping its way up in this high momentum play. Again, 68 is our next upside target. At any day here, we could see a pop and push, and we hit that level. Now that's a Fibonacci upside target. We hit a 15% target with it just a couple of days ago from our most recent trade in SLV, and now we're just letting it play out and mature and seeing where else it wants to go from here. If we take a look at let's take a look at Bitcoin real quick. Bitcoin up 3.8% this morning, going from a support level, having a bit of a bounce. A little tiny green bar is about a 4% move today, so it just shows the volatility. Silver, Bitcoin, maybe it's trying to find a bottom. I think overall it's still struggling. Again, I don't like it. If you are a Bitcoin bug, then maybe this is a pivot low if you want to try and pick a bottom and see if we're going to get a bounce back up to the 100 or 105. But you still could suffer some more pain. And if this trend does continue, which it's generally more likely to continue than it is to reverse, and the trend is down, then it could break down and head a lot lower. If you take a look at the energy space, we have crude oil up 0.8%, bouncing out of this blue support level right here. Again, this is a support level we talked about. It's probably going to have a bounce, maybe trade sideways, but I do think we're going to see this continue to unfold and move lower down into the upper or mid 40s over the next, really could happen over the next week or two.
Silver continues to outperform, advancing methodically in a stair-step pattern driven by strong momentum and structural supply constraints. Fibonacci-based projections suggest additional upside remains possible. Bitcoin, by contrast, highlights the risks of volatility. Sharp daily moves offer opportunity but little stability, and its broader trend remains vulnerable. Energy markets tell another story. Oil has bounced from support, but longer-term patterns still point lower as demand concerns linger. Together, these divergences reveal a fragmented market environment where leadership shifts rapidly and conviction remains fragile across asset classes.
If we take a look at the Mag 7 ETF, the basket here, a little bit of a volatile top. The question is this a head and shoulders, or are we going to see the holiday rally still? The market is pulling back. We've got a lot of people questioning, saying there is no holiday rally. People are starting to say it's over. The people are starting to worry the market is going to sell off in a big way, not just for the Mag 7, but for the whole market. And I think that is actually a very strong sign. The last couple of days has finally been that tipping point where we're starting to see a lot of noise, a lot of concern. Even though the VIX hasn't spiked, we've got people really starting to worry and question and give up on this uptrend. And generally, just because we think there's a holiday rally and it hasn't happened, people are actually starting to give up on it. And that's what we generally need to see. We need people, even if you know the technicals, when the people who start to give up on the technicals start to change their tune, that's usually when the market turns around. And so we had somebody say, hey, Chris, are you still following your trading rules? It doesn't feel right here. It feels like the market's going lower. The Christmas rally is canceled, and that is a bullish sign. So, of course, I'm following my rules, and we're just going to let this market play out. If it does play out and unfold as the statistics and the trends are pointing to, we could see still a very nice rally. Now, this is in the mags. We could see the Mag 7 rally about 6 or so percent. If we go and take a look at the QQQ, we could see a fairly significant bounce from this level, which will bring us up. Let's just see percentage-wise. There is a percentage move of about 6 or so percent as well in the NASDAQ, and probably 5% or so in the S&P 500. So we just have to let the price play out. If the market doesn't shake you out, it will wait you out until you give up with enough concern and worry.
Perhaps the most important shift is psychological. Confidence in a seasonal rally is fading, and skepticism is replacing optimism. Ironically, this growing doubt may be constructive. Markets often turn higher not when investors feel safe, but when they feel exhausted and uncertain. As traders begin questioning strategies that once felt reliable, conditions for a counter-trend rally improve. If price stabilizes and sentiment continues to deteriorate, the groundwork may be laid for a meaningful rebound. In markets, it is rarely the headlines, but the crowd's surrender that marks the turning point.